Hello everyone, this is Ted Bauman here from the Bauman Letter. I have a presentation I'd like to share with you today, which is prompted by something that a lot of people have been asking me about, and that is whether or not they should be preparing for a market correction, or rather, how should they be doing it. There's a misconception about how that should unfold, and I want to talk about it in today's presentation. So, without further ado, here it is. Now, I've titled this presentation "To Sell or Not to Sell," and the reason I do that is because I've been getting so many questions from people saying, hey, you know, you're predicting a correction in the stock market. Should I sell everything and move to cash? Well, you see, that's the wrong question. That should never be the question. If you're in a position now where retirement savings is an issue for you and where you need to be thinking about how to protect yourself from a potential correction, there's another decision that needs to be made first, and that's asset allocation. So let's see what asset allocation is all about. To begin with, asset allocation strategy is rooted in the fact that different types of assets tend to behave differently in response to market conditions. When some are low, others are high, and vice versa. For example, sometimes when stocks are performing well and getting good returns, bonds tend to perform poorly, and vice versa. Or sometimes large caps are doing well and small caps aren't doing so well, or vice versa. Whenever that happens, whenever you have one class of assets that is outperforming another, we say that they're not correlated. Now, specifically, the correlation or the lack of correlation is in relation to a trend in the market. So, for example, when the market turns bear, sometimes you find that other assets have a boom. Gold often rises in a bear market, so we say that gold is not correlated with the market. And in principle, what you want is to try to have a mix of assets that are not closely correlated so that they don't all go down and up at one time. Now, asset allocation strategy is basically the practice of trying to mix those non-correlating assets together to find the optimal balance of risk and return based on your investment profile. And that has a lot to do with things like how old you are and etc., which I'll speak about in a moment. But the goal is to try to minimize the overall risk to your portfolio while maximizing your returns. And that's how you get the most efficient possible portfolio. In fact, there are some people who talk about the efficient frontier, which is, you know, the relationship between risk and return. So what we're doing here is trying to achieve that optimal efficiency. Now, this is something that people have been talking about for a long time. Back in 1986, there was a paper called Determinants of Portfolio Performance, which basically showed that asset allocation is the main thing that determines the long-term variability of your portfolio's return. Okay? Remember, the variability of your portfolio's return is what we're talking about. On the other hand, active management like stock picking and market timing play relatively minor roles. Now let's unpack that. Remember, the focus is on variability, not necessarily return, right? We're not saying that the absolute level of return is better when you have an optimally non-correlated portfolio. Nobody is saying that good stock picking and timing can't get you better returns. The point is that over time, you're more likely to get steadier, more predictable returns from a solid asset allocation strategy than from stock picking. Now, the reason for that is pretty straightforward. If you have a mix of assets that are non-correlated, then over time, when there is a downturn in one of those assets, other non-correlated assets will continue to perform well or even outperform, and that will help keep your overall portfolio in good shape. So in other words, it's all about time, and we're looking at it from the perspective of time. And so over time, and I'll talk about how that's important through specific strategies in a moment, the overall allocation of your portfolio to different asset classes is more important than your individual selection of stocks or bonds or other securities. You might say that the ability to pick the best securities within a specific market is much less important than your choice of which asset markets to invest in the first place, right? So basically getting the balance between stocks, bonds, cash, and alternative investments is really where all the action is. Now, this doesn't mean that this is something that you do passively. You can be as active as you like. You can basically move funds or resources around between different kinds of asset classes like stocks, bonds, cash, and alternatives. But the critical thing is that whatever you do should be related to your goals, your age, your tolerance for risk, the size of your portfolio, and your expectations of where you think the market's going. But basically, the longer your time horizon, the more active you can be. That's because you have more time to recover from downturns, right? That's the critical issue. The longer the time frame, the more active, the more risky you can be, because you have more time to recover if there's a downturn. But as you get older and the time frame between when you need to start drawing on your investments reduces, your asset allocation strategy should become less active and more passive, right? In other words, you should stop messing around with it, and you should try to find out or figure out an allocation strategy that will protect you from any potential downturn. Now let's take a couple of cases. Somebody in their mid-20s, you have more time to ride the ups and downs of the market. Your portfolio has the time to recover from a downturn. I mean, if stocks were to drop by 50% tomorrow, within 2 years they'd be 50% back up again, and you'd basically continue from where you were. And because there's so much time left in your investing life, you can afford to have a higher proportion of stocks, and within your stock portfolio you can have a higher proportion of riskier, high-yielding stocks like biotech and things like that are a little more on the speculative side. But your asset allocation strategy will adjust as you get older, and you might want to change it based on events in your life. I mean, if you, for example, lose a job and you have a period without income, at that point you probably want to shift to a more conservative strategy, because it'll be more difficult for you to put more money into your portfolio while you're looking for work. Or if there's a big downturn, you might want to adjust your portfolio based on that fact. But the basic idea is that the younger you are, the more risk you can afford, and the less balanced, if you like, your portfolio can be. It can be more stock heavy. If you're 10 years from retirement, the likelihood of a major crash is less than if you're a 20-something. Think about it. If you've got 40 years to go, 45 years to go before you retire, the chances that there are going to be significant market corrections during those 45 years is a lot higher than if you're 10 years from retirement. Right? Statistically, the longer the period, the more likely it is that an event will happen. The point is that the implications of a crash are much higher when you have only 10 years left, because you don't have as much time for your portfolio to recover from that crash. So let that sink in. That's the key message. Even though the likelihood of a crash is lower, the potential damage is more as you get older. Because remember, you'll be taking drawdowns from your portfolio in a few years. And if you have to take drawdowns when your portfolio is at a low point, that'll leave you with less overall assets to invest, which means that your portfolio's value will decline more rapidly than if you were drawing down at the peak of the market. So at that point, 10 years from retirement, it's much better to increase your low volatility, uncorrelated asset holdings to avoid the kinds of big drawdowns in your portfolio as a whole that would force you to liquidate assets in a bear market. And that means having more bonds, having more cash, having more low volatility assets like the ones that I talk about in the Bauman letter for September. Now, what about when you're in retirement? Well, the simple point is that there is no time to recover from a downturn. If there's a downturn, you really can't afford to take any big risks. You should be emphasizing safety. That's, of course, unless you have more money than you need, in which case you can use that money to play around. But that's not the case for most people. So you need to have a safe asset allocation strategy, big on bonds and cash, possibly including alternative investments that are definitely non-correlated, like collectibles. Stamps is one of my favorite. But by all means, you don't want to have the bulk of your portfolio tied up in a risky set of stocks, particularly the more volatile ones. So let me leave you with two bits of wisdom today. There's something I like to say to people that always gets their attention. Number one is not losing money is just as important as making money, right? I mean, think about it. You made the money, but what's the good if you lose it? So putting as much effort into not losing money as making money is really important. And the second thing is, think about it. Every day that you don't lose everything, you've made a 100% gain relative to the alternative. Now, with those two pieces of wisdom, I'll leave you, and we'll
talk about this issue, I guess, probably in the next couple of Bauman letters.
Well, I hope you found that useful. I think it's important to take these ideas on board because they really are at the core of any sensible asset allocation strategy, particularly as you are preparing for retirement. Remember that this is the focus of the Bauman letter. We want to help you to keep the money that you've made. We want to make sure that you proceed safely into your financial future. This is Head Bauman signing off, and I'll talk to you again soon. Bye-bye.